This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason. Welcome. Today, final thoughts on the 2026 crop insurance decisions. With us is Nick Paulson and Gary Schnitkey, both agricultural economists, members of the FarmDoc team right here on the Urbana-Champaign campus of the University of Illinois. Our outline for the day includes price discovery results, crop insurance changes, and the SCO ECO questions that you're probably asking yourself, maybe still, and what you should do about that. Net benefits, risks, the profitability, probability of regret, which sounds like an interesting topic, and the 2026 crop insurance decision resources that are available through the FarmDoc team and the FarmDoc website. That's at farmdoc.illinois.edu. We'd also like to take time to thank our sponsors as we get started for the day: the TI Center for Farmland Research, CoBank, Compeer, Corteva, Farm Credit, FS Growmark, the Illinois Corn Growers, the Soybean Association, and of course, John Deere. We'll kick off our program, I believe, Nick Paulson, with you today. Good morning. Thank you.
Morning, Todd. Thanks for the introduction as usual. And as you said, joined here in the studio with Gary Schnitkey. And so we did a kind of a first look at 2026 crop insurance decisions back in mid-February, I want to say. At that point, we were still in the middle of the price discovery period during that month of February, where we're setting the projected prices and then also the volatility factors, both of which impact the premiums that producers pay. The projected price also impacts the dollar value of the guarantees that can be achieved along with your farm APH or expected yields if you're looking at some of those area policies. So where we ended up with in terms of corn is a 462 per bushel projected price. And that's based on all of those prices that you see, that ending value column there. Those are the settlement prices for all of the trading days in February. Those, again, ended up averaging at that 462 level. The volatility factors, it's the last 5 days, what the options market is telling us in terms of the likelihood of variability in those corn prices between now and the harvest period where we'll set the harvest price, and that volatility factor ended up at 0.15. Comparing those to previous years, that 462 price is 8 cents below the 470 we had in 2025, and then a little bit lower than the longer term average. If we look at a bit longer history, right now we're looking at over the last decade. You can see kind of how that 462 compares. As I said, below 2025's level a bit, but above some of the projected prices we had in the latter half of the 2010s. Volatility factor, lower than what we were looking at last year, lower than some of the higher volatilities we had, particularly in 21, 22. That will translate to lower premiums than would be the case if that volatility factor was higher. And so that's how that plays into premium cost calculations for the year. If we take a look now at soybeans, here in our next slide, we've got the same information there. We ended up at $11.09 per bushel projected price for soybeans, a 13.13 volatility factor for those. In terms of how they compare to the last 10 years, that 11.09 is 55 cents above, I believe, what we had in 2025, which was a 10.54 price. And that 0.13 on the volatility factor is a bit lower than last year, lower than some of the highs we saw when markets were more volatile in 21 and 22. Again, that little bit lower volatility factor will contribute to lower premium costs relative to if that volatility factor was higher. There's obviously a number of other factors that impact premiums and the rates that RMA sets year to year. But those volatility factors are a little bit lower for both corn and beans this year. All right, so now we're going to move on to, we're going to address some common questions that we've gotten, particularly with respect to the use of SCO and ECO. But first, we're going to, I think, review a little bit of some of the material we covered in the first webinar this year, but we think are important to review, especially if you weren't able to join us for that one or watch the archive. So I think some of the high level highlight points here that we want to make are the fact that there were subsidy rate increases for the combo products. That includes the very commonly used revenue protection plan, as well as revenue protection with the harvest price exclusion that does not provide that harvest price increase, traditional revenue insurance on that one, and then the yield protection policy as well. Subsidy rate increases on those, Gary, were in the range of 1 to 3 percentage points, depending on the coverage level, if I remember right. We provided those values in that February webinar, but in general, that will translate to, again, lower premium costs for the same coverage levels on those things relative to the higher, lower subsidy rates that were in place last year. The big subsidy rate change, though, is in the ECO or SCO program that was outlined in the One Big Beautiful Bill Act. RMA, after passage of that One Big Beautiful Bill, also announced that they are going to be implementing that subsidy rate increase for ECO as well as similar programs. And those are now at an 80% subsidy rate, meaning the producer is only paying 20% of the total premium cost for those products. And the other big point, again, related to SCO here, is we no longer have to worry about when making decisions about using SCO, what our commodity program decision was. So that SCO eligibility is no longer tied to your ARC or PLC enrollment decision, and you don't have to worry about those commodity title choices as you make your crop insurance choices here in the next over the next 10 days.
March 15th is the date where you have to know that crop insurance decision. By the way, commodity title do not have the March 15th deadline this year because of regulations. Just so we all know that. A couple points here. Supplemental coverage in SCO and ECO are area county products. So when you're getting SCO and ECO, you're getting a different coverage than RP, HPE, or YP. RP is a county level product, so it's farm yields that matter. SCO and ECO are based on county yields and county revenue. Again, just to reiterate this point again, this is the big point, is 65 to 80%, and you will notice a 40% decline in those premiums, and that is significant. It also happens to cause our recommendations to change. Again, the One Big Beautiful Bill Act caused that to be on SCO. RMA later added it to ECO and similar products as well. The One Big Beautiful Bill Act also increased the coverage level on SCO from 86% to 90%. That will be phased in for 2027. After which 90% ECO probably will not be available, would be my guess. So those are the changes that you will likely see. So finally, every farm should consider SCO and ECO in 2026.
I think that's kind of been the main point of everything we've been writing about on FarmDoc Daily for, I don't know, the last month and a half. Probably.
Last month and a half. Think about ECO. And here's sort of, again, we're going to go through some questions here, and we got a couple questions already, and we'll cover those as we're going along. But here's sort of our ECO, SCO recommendations. Strongly consider ECO 95%, and I would consider that over ECO 90%. Two reasons. Number one, and 5% revenue loss is easier to trigger than a 10% yield loss. Number two, RMA's ratings for higher coverage levels on SCO are better, not perfect, better than 90% and 86%. So they get the 86% closer to being correct.
Quick question on that. Is that for both corn and soybeans, or do they differ?
You would do ECO 95% on both corn and soybeans. All right. I would say consider lowering RP coverage level. That will come in with certain trade-offs. You will be trading off a county product for a farm level product. So there are situations in which the farm level could pay and the county won't. And the third thing then is add SCO to cover the layer from 86% to RP coverage level. And that's the last thing I would do. Take ECO 95% first. You do not have to take SCO, but take ECO 95% first. All right. So here are some common questions. Should the fact that county expected yields for ECO, SCO, and all these county level products lag actual yields influence my decision? And here's the thing. If expected yields are below actual county yield, the potential payments are less likely to be triggered. This will give you a feel for the situation. The green line here is actual yields in Logan County, Illinois for soybeans. The gray line is expected yield. So in 2026, and we began this whole thing in 2015. So you can see here in the last 3 years. So for 2026, expected yield for soybeans in Logan County is 73.5 bushels per acre. RMA raised that from 73, or excuse me, up to 73 from 71.7 bushels per acre. So between 2025 and 2026, RMA raised the yield in Logan County, the expected yield by, now my math is going to fail me.
1.8.
1.8 bushels, and that's above the trend. So they made a significant adjustment to expected yields. If you look at that 73.5, it's probably still lagging what's going to happen in Logan County, but it's better than it was a year ago. Here's and this is a pretty common occurrence in Illinois. The number one thing that first we would say is that the farmdoc insurance evaluator accounts for this, and we still get positive expected benefits for SCO and ECO in most cases. So if you think about it, what that 80% the subsidy is doing is saying you're going to pay 20 cents and you should get overtime back close to $1. Well, because RMA has it wrong, you're going to get 20 cents. You're going to pay in 20 cents and only get like 45 cents back. Okay.
Still a positive return.
Still a positive return, but see what really happened is that 65% to 80% really made it positive and more of a deal. If this was at 65%, you'd still be sort of going, I'm not sure. But 80% subsidy is kind of covers a lot of errors there. Let's just say that.
Todd, can I ask a question about if the expected yields are below the actual county yield? How far below? And you take SCO if that's the case?
So 73, this shows you Logan County, 73.5 bushels per acre.
Right.
All right. So Logan's county yield has been going up every year, right?
Mm-hmm.
All right. So when's the next time Logan County is going to have a bad yield?
Could be 20,
could be a long time. Could be
a long time. This is where Todd has a farm.
That is why I'm asking.
So I think that yield should be closer to 75, right? 75 bushels. So 2 bushels lower. That's going to lower the probability of that paying.
Yep.
But it's a revenue product, right? So a 5% yield shortfall is pretty easier to happen. So That's what's going on.
Right. So what I'm asking though is, if your yield is lower,
Oh, your yield doesn't matter. Remember this. This is a county yield. This is county yields. County yields. It's what RMA reports the county yield at, which is the average of all the insurance acres in the county.
let's say, and let's make it easy numbers. So let's say your expected yield is actually 70 as opposed to 75.
So
we're gonna cover this.
we
Tom.
are
That's
gonna-
one of our
oh,
other
that's
questions.
why you
right,
keep up
on.
on.
Yeah.
I didn't
Jeez,
look at
Todd
that.
Todd did not review the materials.
I
ahead
did
of
not.
time.
No, I did not. Thank you.
Very common student behavior.
That's true.
No, we are actually going to answer that question.
Well, I would
exactly.
as directly as economists ever do answer questions. We are gonna
And we
answer that
actually have and we appreciate some of our questions on this, because the questions that have been posted have actually prompted that
one.
article.
We're going
So,
to get some of the viewer questions we're going to get to also. So
all right. So ECO 95 and ECO 90%. We sort of covered this once, but we're going to do it again. What about SCO? In most cases, ECO 95% will perform better. And what we see is that it's sort of like you pay in 20 cents and you get 45 cents back on ECO 95, and you put 20 cents in for ECO 90 and you get 40 cents back. All right. So,
and the premium is higher on ECO
it is
95.
higher.
But again, it's a big chunk of that's being covered. And yeah, it's just I think it's the main factor here is just we think the rates are better. The prices are closer to fair for 95% coverage rather than 90 when we look at historical performance. And as Gary said, the likelihood of triggering a 5% revenue loss at the county level is much higher than a 10% loss.
So then we would see, so you're going to take ECO 95. All right. Let's say you follow our advice, which you probably won't, but say you do ECO 95, then think about SCO. I would do ECO 95% first, and then think about SCO. And that will also depend on the coverage level of your underlying plan. But so prioritize ECO 95% first, and then think about SCO. And I guess I think you're going to let the premium cost drive that decision.
Next question.
And this is Todd's question.
So now we're getting to Todd's questions
Okay.
teed up here. So this one I think we've gotten a lot as well, and it's exactly this question about, what if my farm's APH is significantly different from that expected county yield that those area products like SCO and ECO are based on. And I would say we more often get the question from the angle of my farm's APH is well above that.
Yep.
But I think our answer here can be applied even for farms in the other situation where they're below it. And the main point here is that, again, your farm's APH yield and your farm's actual yield doesn't really impact the likelihood of SCO or ECO triggering payments. Now, if your farm did poorly, that means maybe the county did poorly. So that's maybe not entirely accurate to say your farm yield doesn't matter at all. But ultimately, it's the county yield that triggers the payments on SCO and ECO. Now, your APH yield does impact the size of those payments if they're triggered. And you can think of it as effectively your SCO or ECO payment is scaled proportionally to your farm's APH. And so how these programs work is they are triggered based on a loss at the county level, and they apply the percentage loss at the county level to your farm's expected revenue. So if you got a higher APH than the county expected yield, you're going to get payments from SCO and ECO the same times as every other farmer in your county that buys it, but your payment's going to be higher than someone with a lower APH yield, if that makes sense. Your premium is also proportionally impacted.
Yep. And if you think about it, you have a range there. ECO covers from 95% down to 86%. If the ECO product makes a payment over that whole range, it's 100% of that payment over that range. And if you have a higher APH, your liability is higher than the other one.
The other point here, Gary, I think we want to make is that the combo so the combo products themselves, and again, most people are using RP. The performance on those we've observed tends to be actually worse for higher APH farms. So we talk about this rates being maybe generally too high relative to historical performance in Illinois and the Midwest in general for corn and soybeans. That seems to be even worse when we look at farms that have APH yields that are above the average for the county.
Yep. So if you have a farm APH that's 10, 15 bushels above the county expected yield, my guess is that you have not received an insurance payment in the last 10 years. All right. Just go back and think about that. If you're in that situation, you have a high APH. My guess is you have not had an insurance payment, and the premiums relative to the payments tend to be lower for those high APH situations.
So I have another question. Are the farms basically on a classic bell curve around these?
Not sort of.
Sort of that many below and that many above.
Yeah, it's an average. So
Okay.
central limit theorem would say.
Oh, by the way, if you have questions, you can ask them too. And you can do that easily enough. Doesn't depend on what kind of screen you're on. Up in the right-hand corner, there's a little question mark. Hit that box, send a question to us.
All right. So
And we're getting to some of the user submitted questions are going to, I think, be covered here when we discuss this one. So another very common question we've gotten and a lot of analysis that we've done the last month is looking at this decision of whether you should consider lowering your farm level underlying, again, in most cases, we're talking about RP here, coverage, and then adding SCO and ECO to that to replace that coverage that you've lost by lowering the RP coverage level. And we're gonna walk through a number of different ways to sort of look at this, a number of different ways we have looked at it. And they're all going to kind of try to get at this question of basis risk, which again is the trade-off that you're making when you think about lowering your farm level coverage and then replacing with this area coverage, because there is, again, a chance that you could have farm level losses that will not trigger at the county level. And so the more you do this, the greater extent that you do this, the greater the chances are that you will have losses that won't be covered by those area products. So that's sort of what we worry about in terms of the pitfalls here. First, though, because we are professors and we've looked at this in a few different ways, we want to define some terms here that we're going to use. And so we've kind of been using this term net benefit as we've looked at this in the last month in a number of FarmDoc articles. And what we're referring to when we say net benefit is we're really looking at the expected dollars associated with this, not any of the risk management aspects associated with these things, but literally what is the expected benefit that you'll get from this from a straight up dollar per acre perspective. And so this is measured in expected indemnities minus the farmer's cost for the policy, the farmer paid premium.
So what we're saying here, if this is positive, over time, the indemnity payments are larger than the farmer paid premiums. And remember, for SCO, it's subsidized at 80%. And then we're in the, depending on your product, 50s to 80% on the RP product.
So you should expect these measures, these net benefits to be positive, regardless of your insurance choice, but differing levels because of these different subsidy rates.
Yep.
All right, and then we're also one of the risk measures we're going to look at here is a measure of what I would call relatively severe downside risk. And again, the terminology we've been using is this worst case revenue. And specifically, what we're talking about here is the revenue in the 5% of the worst outcomes that we measure in the simulation models that we use to look at these things. So if you work in the finance world, you would recognize this as a 5% value at risk measure. And so when we're talking about both of these things, you know, we want net benefits to be as high as possible. We want this specific risk measure that we're talking about here, this worst case revenue, the higher that is, the better. Because the higher the revenue you can achieve in the 5% worst outcomes we can imagine, the more risk protection it's providing. So hopefully that makes sense, and that's relatively clear. Okay, so in this first figure, we're looking at an example, and you know the values change here from what we'll specifically talk about in this example from McLean County, Illinois. This is also a corn example. We'll show the soybean example next. And what we've got here, the dots on this chart are results from the simulation work that was done by a PhD student that Gary and I are working with, Enrique Monaco. And those are the different types of insurance coverage combinations that one could put together for the 2026 year. So different combinations with different levels of RP coverage, with and without SCO, with and without ECO, 95%, 90%. Those are sort of all the combinations we could think of, looking at RP coverages from what, as low as 60, 65%, Gary, all the way up to 85%.
Yep.
And then all the combinations of those RP plans with the different permutations of ECO and SCO that you could package together. And we're highlighting a few here with colors and arrows that we want to talk about because they're kind of the more commonly scenarios that we think producers tend to gravitate towards. And so in red, we've got the RP 85% coverage scenario. Average coverage level for RP in Illinois is between 80 and 85%. So we see a lot of folks historically have been either at that 80 or 85% coverage level. So we're going to view that as kind of our baseline here, and then compare that to some of the alternatives we could look at that might be different RP coverage levels, adding SCO, adding ECO. So first I'm going to go to the green dots. Okay, and we can think of these as, all right, I'm going to take what I've always done. I'm going to keep my very high level RP coverage, 85%, and I'm going to go for the most Cadillac of crop insurance coverages that I can possibly get. I'm going to add on the supplemental products, ECO 95% alone, or in the case of the one to the right, both SCO and ECO. So what happens here? So we move to the right in this figure. That means our net benefit is increasing. The expected indemnities relative to the premium cost is much higher. We're adding coverage. This is a higher premium combination than just buying RP 85 alone, but your expected indemnities go up considerably, and you go from less than $5 per acre net benefit on RP 85 up to that roughly $30 per acre range in terms of what you'd expect to get out of these things after paying the premium cost on average through time.
By the way, this illustrates also, we take ECO 95 first and then add SCO, and there's very, very little difference.
The big bang for your buck, particularly on the net benefit measure here as we move to the right, is adding ECO 95. SCO in this case with RP 85 as the underline is only giving you another 1%. That scenario is probably the one where SCO is the least consequential addition here, just because it is just a 1% coverage band that you're adding in that case. The other thing here is how far do we move vertically? And in this case, we've moved up from our baseline of around $810 worst case net revenue all the way up to above, probably $865 on our worst case revenue in both of those cases. So again, that's sort of the best you can do from a risk reduction maximization perspective, and you do get a considerably larger net benefit as well. The third kind of grouping we want to look at, and we circled a number of dots and highlighted two of them in blue. This is where you get into lowering your RP coverage level below that 85% kind of maximum baseline here that we're comparing things to. And then you add on top of that SCO and then that 95 ECO product. They're the two dots we've got highlighted there. Okay. What does that do? That even further increases your net benefit. All right. We're going to a lower RP coverage level. That means you're getting a higher subsidy rate than at 85%. So a bigger share of the cost of that product is now being paid for through the subsidy. Your SCO premium is going to go up in those cases because you're covering a wider band. But again, that's an 80% subsidy. And then you got your ECO 95%. So this adds about another $5 to $6 in net benefit. You're really maximizing what you're expecting to get out of the program above premium expenses through time. And there really isn't a significant reduction here in this downside risk, worst case revenue measure here. So we do go down, we drop just below 860 if you go down to 80% RP. You drop a little further down if you go to 75% RP. But you know, it's still an improvement both from the net benefit side and the downside risk improvement when you compare it back to that RP 85 alternative.
I would also just two other comments. We're making ourselves much better in both cases from RP 85, even if we lower RP 75 to RP 75. We've increased our risk position from RP 85. The other thing is, this is the highest net benefit here at 75%. And here's what's happening. These are enterprise units. By the way, yes, SCO and ECO works better with enterprise units. So if you're taking an enterprise unit, SCO and ECO are more aligned with you, but RP 75's premium subsidy hits 80% at the 75% level. So that's why we're getting this movement over here. So actually, in some respects, also, this is a question about, you're giving up a little bit of risk protection, but overall, you're making more money. Over time, which way do you...
In expectation. Always got to be careful. It's not going to occur every year. But yeah, over time, you're gonna get more back out of the program relative to the premiums that you pay in, and improve risk. And then the other thing, and we'll move to soybeans here because the picture is very similar. Again, comparing it to that RP 85% baseline, and for soybeans, historically, with the rates that RMA has in place in Illinois and throughout the Midwest, even with subsidized insurance historically, we're looking at net benefits to soybean coverage below zero here. So it's negative $1 with that RP 85%. So again, you substantially improve your net benefit as you move to the right by $12 to $14 per acre, depending on whether we're looking at those green dots or blue dots. And in both cases, we see improvements in risk reduction with increases in that worst case net revenue measure as we move up in the chart there. Again, Cadillac coverage is going to be your best bet in terms of maximizing risk protection. Those are the green dots there. Those are going to be higher premium costs than just carrying RP 85% on its own. The blue dots, you're going to give up a little bit of risk reduction relative to that, again, Cadillac coverage combination. But you're going to get even more on the net benefit side because dropping down to lower RP coverage levels increases your subsidy rate on that product, in addition to the 80% you're getting on the area plans. The one other point, because we're going to keep talking about this RP 75% plus SCO plus ECO 95% option. Once you get there, you're basically at the same to slightly lower premium cost than just carrying RP 85 by itself. So not only are you improving your performance, your net benefit over time, you're doing so at effectively the same out-of-pocket or a little bit lower out-of-pocket cost than just buying RP 85% by itself.
Before we move off this screen, somebody did ask what the gray dots represent.
The gray dots, again, are just sort of, there's so many dots, we couldn't talk about every one of them, but they are all the different combinations you could think of putting together between RP from, I think we went all the way down to 60%, maybe even 55%.
Right.
But all those 5% increment coverage levels, all the way up to 85%, and then combining that or not combining that with SCO, ECO. And so there's a lot of different ways you can combine these three products together. We're kind of just focusing on the ones that we think are most relevant for what most producers purchase and what they're probably thinking about for 2026.
So we sort of, so let me, now I lost my, oh, there it is.
And we are showing enterprise unit examples.
Yep.
All right. I'm back. I'm sorry. So, oops, I'm sorry. So we had a question, where are the SCO blocks or without SCO blocks in here? And I screwed this up. So these dots right here, we're actually lowering our coverage level more than 75% to get these dots over here. And these are without SCO right in here.
So be lower our kind of where you were just hovering around there, circling those grayed out
Those
to
were
be lower RP
70
coverage
and
levels.
65,
Yep. 70, 65, even down to
That's
60. I
above
think.
$640.
Yes, what we're seeing here is just you're giving up that premium on that RP policy, which is never paid, essentially. So your SCO sort of is right here, and here we're lowering from 75% down to 60%.
Yeah. So specifically, the question that we got is what would be the impact on the blue dots if we drop SCO? And again, just to reiterate, that's sort of where Gary was circling around there.
Right here.
Those
right?
would be kind of those lower RP coverage levels with ECO, but without SCO.
But the other three that are inside the bound of the circle are just lower RP coverages, correct?
With SCO
With
and
SCO.
with ECO.
SCO, yeah.
With both of the optional county add-ons, but even lower RP coverage levels. Yep.
Okay.
And these are both enterprise unit examples in this case.
All right.
So this is a question. Do you take into account the time value of money? This is a good question. SCO and ECO are going to pay in June. If it pays it all for the 2026 year, it'll be paying in June 2027. No, we do not consider the time value of money. You're right. We probably should, but yeah.
All right. So we're gonna move on here.
I'm sorry.
Gary keeps trying to drive on me.
All right, you're
We got.
I'm not driving.
We got too many ways to advance slides here. So again, kind of sticking on this topic of because so many people have asked about it, and we've done so much analysis again recently on these scenarios where you're lowering your RP coverage. By the way, this is a strategy that this is the first year that we've ever looked into this so much, and I would say got anywhere close to suggesting that this is what farmers do. That 80%, that increase to 80% subsidy on these SCO and ECO products. Gary said it before, but that is enough of a game changer that we now feel comfortable, I think, even maybe recommending this as a strategy. In the past, even with the 65 subsidy rate on SCO, I don't think the numbers made sense to take on the basis risk that is introduced. But again, that subsidy rate increase is really the game changer here.
So we had a question about optional units in this. The optional units, if we did that graph, would look the same as far as where the spacing of the dots are. You can look at this on our insurance evaluator, which we will show here, and look at basic units. We didn't go down to optional units in that presentation, but that graph will be the same with optional units.
Does this graph show up in the evaluator?
No, we made it.
Oh, see.
Well, what the evaluator shows you is any one dot at any given time.
Okay.
So, all right. We can always think about ways to improve for next year.
All right.
All right. So again, a little bit more discussion here on basis risk. And this we start to get a little more academic here once we start talking about correlation between farm and county yields. But think of that horizontal axis there at the bottom. As we move to the right, think of that as being a case where your farm tracks the county less and less historically. Relative to further to the left, you might be in a situation where you look at your yields historically versus the county. When the county's up, you're up. When the county's down, you're down. As you move to the right, these smaller correlation numbers, that would be the case where, you know, if you looked at your yields historically, you might have a great year, the county's down, vice versa. That might be a more common thing. So that's what we're talking about here when we talk about yield correlation, just how closely those farm and county yields track one another. In Illinois, you know, the data that we have access to look at farm yields versus county yields, most farms are probably in that 0.7 or even a little bit higher range in terms of correlation. Here in the Midwest, our farms do tend to follow the county more closely than areas that were more variable. Southern Illinois is a little different than Central Illinois and Northern Illinois. But what we're showing on this chart is what happens to that risk reduction relative to that RP85 benchmark as we lower the yield correlation. So think of this as like, you know, if I'm a farm that tracks the county very closely, my risk reduction is going to be even better by looking at lower RP coverage levels, adding these county products than what I could get out of RP85 versus if you're a farm where your yields don't necessarily track the county very well. As we move to the right here, those decreasing lines are just showing that the worst case revenue measure, that risk reduction measure, gets worse and worse relative to that RP85 benchmark. And if you've got a farm that's completely different than if you got an insurance unit that's totally different from the county, you know, we could be in situations where, you know, it doesn't make sense to talk about these strategies that we've been talking about from a risk reduction standpoint. Net benefits are the same. So you can still significantly increase your expected indemnity relative to your premium cost, but it does impact the risk implications for you. All right. So this is a concept here. We're going to define one more thing, and this is this probability of regret that Todd pointed out was an interesting term. I don't know. I don't want to take credit for it if this is something people like, but I'm happy to take credit for it if it's something that people think is silly. But basically, probability of regret, when we talk about this, we're comparing a high coverage level RP plan as like the baseline option. And again, we're gonna specifically think about RP 85% here. And we're gonna compare that to a lower RP coverage level with these county products added on top of it. Specifically, the one comparison we're gonna look at here, just to keep things simple, is RP 85 as a baseline versus dropping down to 75% and then adding SCO and ECO 95%. So what is the risk that you run here? Well, I think one thing that a producer would be concerned with here is, what if I find myself in a situation where my 85% RP plan would have triggered a larger payment than what I'm going to get out of my lower RP coverage plus my county add-ons? Okay, so what if the indemnity from A is bigger than the indemnity from B? And that can happen. All right, we're going to think about this visually now as well. So if we compare these two coverage scenarios, we've got our RP 85% baseline on the left versus our lower RP coverage level plus the add-ons on the right. And what we're concerned with here is what I've labeled as that individual coverage gap. Okay, so technically you still have coverage from 85 to 75. You actually have coverage now from 95 to 75, but that's been shifted into a county-based product. And so there's always a chance that that 10% farm level revenue range from 85 to 75 would have generated a larger payment from RP 85 than it would from RP 75, and the county doesn't trigger. Okay, and so there are instances where we could see that baseline high RP coverage here pay a bigger payment than what we'd get from that alternative. All right, here is what our simulations would suggest is the likelihood or how common that type of situation would be. And if you look at the probability of regret columns there, we've got it measured across regions of the state as well as the statewide average. And we're looking at, in northern and central Illinois, basically a 1 in 20 chance that might occur, whether we're looking at corn or soybeans. and a little bit higher, not quite a 1 in 10 chance for Southern Illinois, but maybe a 1 in 15 chance for Southern Illinois. If we're looking at the odds or the likelihood that RP85 plan would result in a bigger indemnity than the combination alternative. Again, we are going to be paying, in general, a lower premium for that lower RP rate, plus the area add-ons. That's the premium difference averages that you see there. And again, not considering the risk reduction impacts, we are expecting to get a lot more out of that alternative product through time. That's that net benefit increase that you see there in the $30 to $35 range for corn, even a bit higher in Southern Illinois, and in the $15 to $20 range, depending on the region that you're in, for soybeans.
And so, yeah, just simply, there is a chance that there will be a payment that there, 1 in 20.
Yep. All right. And again, this probability of regret does vary across the state. So we divided those regional averages, the statewide average in the previous slide. This just gives you a sense of some of the regional variation. Again, higher risk of this, higher likelihood of this in Southern Illinois. That's where we see more yield variability in general. Very common to think about these area plans as potentially not matching up what happens at the farm as we get into areas with more production variability.
Can you go back one slide and explain the net benefit to me again? So the net benefit is over the 10-year period or 20-year period or whatever.
The net benefit is an expectation, or what you would expect over time to get out of these above the premium that you put in. All right. So,
and that's a $35.60 net benefit of the RP 75% over the RP 85%
right, so,
over time. So if you use the 75%, your expectation was there might be a time where you really actually don't get paid more, but over time, $35.
Yeah. So if we go back to this chart, might make a little more sense or clarify a little bit. So again, if we're looking at that blue dot all the way to the right there, that's the alternative we're looking at,
right,
comparing that to RP 85. So we're going, in this case, this is McLean County, not Logan. So we're going from about a $3 to $4 net benefit on RP 85 to a $36, $37 net benefit.
Same as
and so it's the difference, right, okay, there, the difference. Over not quite $35 per acre here for McLean County, but
okay.
And then soybeans, again, -1 all the way up to 14 to 15. So a $15 swing there. Pretty consistent with those averages we see here for Central Illinois.
But Todd, if you look at Central Illinois, or look at one of those, but I'm going to take the number 3560.
Mm-hmm.
We would expect the RP 75 plus SCO plus ECO 95 over time to have a increase our net benefit $35.60. That's an expectation. There'll be years when that does not work out, and other years where it does. But that is also why it sort of seems to be a, hey, let's get the ECO in there.
That's a yearly average.
That's a year.
Oh, I thought that was much longer. Right. Okay.
A yearly average. But so this year, but see, again, this year you could pay all that premium and not get anything back. Whereas other years you will get the premium back plus. And if we average all those cases, if you could repeat 2026 many times, we would expect you to have $35.60 more benefit for corn, $15.51 for soybeans. So, and we make these, we're pretty strong on that recommendation because that's a pretty good size number.
It is.
And again, it's an out-of-pocket premium cost that's actually lower than just RP 85 on its own. So that's those negative numbers in that premium difference column. So it's not that you're buying a more expensive insurance coverage. You're actually, I think in virtually all counties in Illinois that we look at this comparison, that RP 75 plus SCO plus ECO 95 is a little cheaper than RP 85.
Yep. Okay, so we have roughly 8 more slides to get in 10 minutes.
And by the way, so we have this question. ECO will mimic the basic policy methodology. Yes. So if you buy RP, ECO and SCO will act like RP. It will act on RP, which is a guarantee increase into it. If you buy YP, it will be a yield product. And it follows an enterprise. If you're thinking about it, if you're going to get paid at the county level, it's going to pay on all the units that you have, whether it's one enterprise unit, one or all your basic units, or all your optional units.
All right. Well, I think we are kind of at the guidance stage, so I think we'll get wrapped up here pretty close to on time, depending on how many more questions we get. But again, just to reiterate some of the things we've observed in the guidance we're giving for this year. Again, ECO, I think, is a much more attractive and reasonable choice in 2026 than it ever has been in the past. The scenarios we've looked at and covered in some ways today is we're seeing you can actually improve the risk benefits from your coverage combination that you put together with these things. And the high subsidy on these things can really increase what you can expect to return back out of your insurance choices through time. As Gary's pointed out, this 95% ECO option is really the one that we would prioritize first. It is more expensive, but it's also going to be one that's going to trigger a whole lot easier, because a 95% coverage level is significantly different than a 90% coverage level, particularly when we're looking at county level performance in the Midwest, where we don't have the same level of farm yield variability and nowhere near the same level of area yield variability that exists in some other places. And again, ECO is probably the thing you'd look at first. SCO would be sort of the next thing you'd look at in terms of if you wanted more coverage. SCO, again, may not be needed, particularly if your underlying policy is going to remain at a high coverage level. SCO is not going to cover a significant band. For example, if you're going to continue to carry RP 85 under ECO. But as we talked about here for the last few minutes, there are a number of folks this year looking at lowering their RP coverage level to save on premium, replacing it with that highly subsidized, those area plans. SCO can be used in these cases to cover that gap. And as that gap gets bigger, I think that's becomes more of a recommendation to do that. Probably also more advisable for soybeans than corn. In terms of just that overall lowering your RP coverage, thinking at all. And you do need to consider the basis risk. And the other factor that's been brought up to us, particularly by folks in areas where this is a bigger factor, lowering your RP coverage does translate to impacts on your prevent plant coverage. And so if you're in an area where that is an important factor for you, that also should impact that strategy. All right. So as we wrap up here, we do want to just, and I'll let Gary switch to our browser here. Hopefully this works.
Yep. So we're going to switch. We have online tools that you can use, and I'm going to switch to it. Hey, we're cooking on all cylinders there. So if you go into this farmdoc page, you will go to tools, crop insurance tools, and crop insurance payment evaluator is one of those. We also have the crop insurance premium calculator up here as well. And this is a worksheet where you can look at premiums as well. We're just going to go into the payment evaluator, which is the online tool.
And to be clear, this is the FarmDoc site, farmdoc.illinois.edu, not farmdocdaily.illinois.edu.
You can actually get at them both ways.
Yeah, but you can get to it from both sites. It's just
yeah. So, and then here, by the way, we're going to go over this quickly, but if you click here in the documentation side, you will see a FarmDoc Daily that you could ignore if you want. But we do have documentation there.
You can read all about it.
You can read all about it. Along with there is a YouTube that will walk you through it if you so choose.
Ah, good point.
So, but you make your choice. I'll do Illinois. I will do, what am I going to do? I'll do McDonough County just for the
Just
fun
to be
of it.
different.
Just to
There
be
you go.
different. Do corn. And then I'm going to choose a 500-acre unit. And what it does is it populates an APH yield and a farm trend adjusted APH yield. We don't have the ability to change those. We put a run in a case. We may work on that, but that will not be available this year. Then if you click Run Evaluator, you will see the option. This we have a RP 80%. So we put a RP 80% in here. We could do this at RP 85, then run the evaluator again. 1891, 1881. So let's do that. So we have, how would RPHPE compare to this recommendation? Well, let's see. So I'm going to run this with RP harvest price exclusion, run the evaluator. We will add Wisconsin to this tool by the end of the week. So just so you know.
Good to know.
All right. So farmer pay premium on RPHPE 965, average indemnity payment 1335, 370, 17% frequency, and 807 is the worst case scenario. I'm going to go into compare mode. So there's my RP 85. Let's just do what we've been talking about. Edit this. And I'm going to drop this to 75%. Save it. All right. I dropped my premium from 965 to 612.
That's with, looks like that's without SCO.
No, I've had SCO.
Oh, SCO's on, sorry. And then do we want to do 95% ECO?
95% ECO. So I have roughly, in this case, I have roughly the same premium. My average indemnity payment goes from $1335 to $3660. By the way, these things mean it's going up from your base case.
Mm-hmm.
My benefit goes from $370 to $2660. 37% frequency, $839.
So I've increased my net benefit here substantially from under $4 to just over 26. And then again, that risk reduction measure here, where we're looking at that kind of 5% worst case revenue measure, went from 807 up to almost $840.
No, I just this is 95% with SCO, 95% coverage level, still 75. And I just did not do the supplemental coverage. My premium drops from 965 to 8. I do drop my average indemnity payment from 1335 to 2733, and I do drop my net insurance payment, but it's still better than here, and I'm paying less premium. So there you go.
When you use this, would you say to your base, you want to put your base in as what you normally would take, and then compare, and then you can change it obviously on each of them to start comparing, but just to get a rough idea. So if I'm normally an 85% RP,
this was
or an 80%,
what we thought when we designed this was that you would put what you took last year,
right?
And then you can change things. By the way, you can go wild.
Add another panel to your table.
Yep.
Oh, wow, man.
So if you just want to keep adding stuff,
It'd only be better if I could put my own APH in. I'm just
there's a lot of things. We will also be adding Michigan tomorrow as well. We're releasing Michigan and Wisconsin for this year.
All right. Well, if we want to go back and Todd will probably want to do a wrap up here. While Gary's doing that, I'll quickly, I think, cover a couple questions here. So one is, couldn't you also look at ECO as a put at 95% of the spring price? And if we're thinking about that, we got a projected price of 462. So that would be like a put at 439. If the county produces the expected yield, ECO would then trigger if you got a 5% or larger price drop. That is right. Again, that's assuming that the county is right at the expected yield. typically when you have price drops, we're going to tend to have yields above expectations more so than below expectations. But yes, conceptually, and that's the way a lot of I think farmers and even insurance agents are kind of thinking about this product. It is a product that I think probably is going to be driven. I think historically has been driven more by price declines than yield declines in terms of revenue losses that will trigger payments. And again, that 95% coverage level, it's much easier to get a 5% loss and trigger a payment than a 10% loss or a 15% loss if you're talking about your farm level coverage. So I think that's correct.
Just a note here: if you do take RYP and then you add SCO and ECO to it, it's yield, not revenue. It's yields. The ECO and SCO always mimics what's going on
The underlying coverage.
Does harvest HPO, and I'm assuming that's a harvest price option, apply to ECO and SCO? So yes, if you take the RP product, which has the guarantee increase in it, the ECO and SCO product will also have the guarantee increase in it. So it just mimics that.
All right. And then the last question we'll answer here is before we wrap up is, why does the probability of regret go up when the net benefit also goes up in the Southern Illinois region? Again, it's actually for the same reason why both of those things increase. So we have more yield variability in Southern Illinois. That translates to higher premiums. And the higher the premium, because subsidies are all percentage based, the higher cost insurance is going to naturally have larger net benefits. You have to put more in on the premium side, but with that 80% subsidy, you're also ratcheting up the payment you're going to get back on it. And more highly variable areas, those payments are more likely. So the net benefit increases in more variable areas. More variable areas are also where we see kind of those basis risk measures increase or get worse. So it's really all driven by the amount of production risk that we see.
We'll wrap up quickly now. Thanks to both the two of you, Nick Paulson and Gary Schnitkey, agricultural economist here on the Urbana-Champaign campus of the University of Illinois. Jim Baltz is behind the scenes. Of course, our sponsors, the Center for Farmland Research, CoBank, Compeer, Corteva Farm Credit, Growmark, John Deere, the Soybean Association, and the Corn Growers Association. Our educational partners include the FBFM, University of Illinois Extension, the Department of ACE, the college as well, ACEs, and the Gardner Agricultural Policy Program. You can always find this again if you'd like very soon. Jim Baltz will have it up probably this afternoon on our YouTube website, youtube.com/@farmdoc. You can find it other ways as well. Or you can just go to farmdocdaily.illinois.edu, look under webinars and events in the archives section. Before we go, somebody from North Dakota wants to know, will you put the insurance evaluator up for them?
Probably not get to that.
I'm sorry, you'll have to talk to Frayne. He might have better ideas for you.
Unless Frayne was the one asking the question.
Oh, it could be. I don't know. Frayne Olson, of course, agricultural economist at North Dakota State University. I talk to him once a month at willag.org. Speaking of which, this afternoon, if you want the short version of this, Gary and I are going to record momentarily. It'll be in today's closing market report. You can find that just by searching out the Closing Market Report on your favorite podcast application. Listen to it on WILL AM 580 in about 2/3 of Illinois and 2/3 of Indiana, and find it at willag.org. On behalf of Jim Baltz, Gary Schnitkey, and Nick Paulson, I'm University of Illinois Extension farm broadcaster Todd Gleason. You have a good day.